I would say moderately, and more so economically than, say, the service sector stocks. This is where magnitudes are important. So basically, the fact that they brought in something like 150 billion in tariff revenue has to be compared with the fact that the US is a $30 trillion economy, right? So that's a non-trivial amount. It's not as though that's going to shut down the economy. In addition, some of that was buffered by the front running, where companies were able to kind of pull in stuff ahead of time. So even as, new purchases are coming with tariffs, they generally had inventory that they could still sell at prior prices. So I do expect to see some ongoing consumer price pressures from this. I'll be watching purchasing, like import prices, pretty closely to see to what extent, if any, foreign exporters are absorbing it. So far, not much. When we look at the recent GDP print, one of the things that complicates this, that tariff front running adds noise to the GDP figures. So if you remember, quarter 1 GDP was reported pretty weak. And that was negatively impacted by a lot of that import front running, because when you have a big uptick in imports, that puts downward pressure on GDP. And because we kind of have the hangover from that, where there's like less importing now, that's actually good for quarter 2 GDP. When you look at final domestic sales, the portion of GDP, that was markedly decelerating in quarter 2. It wasn't a catastrophic print, but it wasn't a very strong print. Also, if you look at CEO confidence, it's been down significantly recently, which is not great generally for CapEx and hiring. And so overall, I wouldn't say there's massive red flags in the economy, but there's certain yellow flags. I've generally been in the pretty bullish camp through 2023 and 2024. And here in 2025 is kind of the first time in a while that I do have more concerns overall around both the state of the US economy and stock markets. But that's still in the picture of we're still running very large fiscal deficits, which for many industries are a stimulus. So generally what I do is I look at things industry by industry, and I'm trying to determine, is that industry in a recession? Is it priced for a recession versus other ones that might be, at risk for a recession, but not priced for it? So I generally view sector by sector, industry by industry, rather than the whole economic picture. I would say most are not yet in recession. If you look at the real estate sector is in recession, it's priced for it. The financial sector that deals with it is generally priced for it as well, but I think they're holding up pretty well fundamentally. The part that I think is worrying is the labor market, which has not shown signs of cracking yet, but the flywheel could start to go negatively against it. So right now, no major red flags, but I think that as we've gotten past the buffer from front running of tariffs and the inventory, to the extent that these stay in place for another quarter or two, I'll be watching the GDP pretty closely, because I do have increasing concerns around broader deceleration overall. Right. So the nothing stops this train thesis focuses a lot on the fiscal side, which is the U.S. is kind of locked into pretty high structural fiscal deficits going forward, especially on the spending side. And since that talk, the big beautiful bill has also kind of further locked in some of the things I've been talking about, which is in any sort of investable time horizon, we're not meaningfully cutting Social Security. We're not meaningfully cutting Medicare or defense. Interest expense, even if we do get moderate short end Fed cuts over the next year, on average, interest expense is now, I think, structurally higher than what we got used to over the 2010s. And so overall, we're doing pretty significant deficit spending. It's only partially offset by the increased tariff revenue, which is, again, mostly coming out from Americans, either the consumer side or the businesses, or a blend of both, depending on, what products in question. And so overall, that tends to run things pretty hot. And that's where the breakdown is really important, because if you're on the receiving side of the deficits, it's pretty big stimulus. On the other hand, if you're not on the receiving side of the deficits, you're more facing the higher, tighter monetary policy, you're more facing the tariff revenues, you're kind of out of luck, more or less. So it becomes very sector specific. And generally speaking, gold and Bitcoin, the benefit is they don't have margins to worry about. They're not subject to the tariffs. They're not buying things at higher prices and then trying to figure out what percentage they can pass on to consumers in the way that American businesses generally find themselves in right now. And so I think we're past the worst parts of this cycle's liquidity crunch, which was 2022. I don't really see that happening in the horizon. I mean, eventually we'll have something like that again, most likely, but nothing's really on the horizon for a major liquidity crunch. And so I generally think that market conditions globally are going to continue to be conducive for Bitcoin. And, to some extent, gold. We got a little bit overheated. It was one of the most overbought we've seen on the monthly RSI, which is why I got somewhat near-term concerned around gold. But structurally speaking, looking out 3 to 5 years, I continue to be quite bullish on Bitcoin and gold. And Bitcoin, I tend to follow a little bit more cyclically, and I still don't think that this particular bull market is finished yet. I do think there's a fundamental shift. And people said the same thing around Bitcoin. They were like, Bitcoin's a zero rate phenomenon. It won't do well when you have high rates. And here we are at high rates and Bitcoin six figures and gold comfortably well over 3,000. What generally changed was that we entered fiscal dominance. When you have pretty low public debt and most of the money creation is coming from bank lending, when you raise rates, you generally slow down bank lending at a bigger degree than you blow out the deficit. On the other hand, when you have over 100% debt to GDP on the public sector, and most of the inflation is coming from monetized fiscal deficits, not from excessive bank lending. When the Fed does what they're doing now and they raise rates and try to keep them high, they actually blow out the fiscal deficit by a bigger number than they slow down bank lending. For the most part, they don't greatly slow down total credit growth in the way that they're trying to. So basically, when they sharply raised interest rates in 2022, that temporarily brought everything down. But then as soon as we started to get some of your treasury offsets, we started draining the reverse repo facility, even though the Fed was remaining hawkish around the margins, a lot of conditions were still improving at that point. And that's generally a sign of fiscal dominance, that even high rates don't really do what they used to do in terms of slowing things down. Sometimes they just add fuel to the fire. And so I think that's structurally what changed this cycle. And I think that that's a more persistent regime that we're in now. That's not even a near-term thing. That's just kind of structurally the environment that we're in now. There's still be correlations where if the dollar goes through a strengthening period as it has in recent weeks, that can put downward pressure on gold and certain other assets. But in the grand scheme of things, I think that correlation, that interest rate correlation, is severely reduced now. And it's more about what's happening fiscally, how independent is the central bank perceived to be, and factors like that, more so than just that interest rate correlation. In terms of raw return potential, I'm more bullish on Bitcoin, and that's worked out well for the past 5 years, just because, gold's a 20 trillion plus asset, Bitcoin's a 2 trillion plus asset. And I think that Bitcoin being a 16-year-old asset, it's basically gold combined with a tech stock. It's growing into whatever total addressable market it's going to reach, whereas gold's already closer to its total addressable market. So in exchange for basically more tail risk, more volatility, Bitcoin comes with higher returns. And so on an absolute basis, I expect better Bitcoin returns than gold returns. But the way that I generally characterize it is, because I've been a bond bear, I basically said, if you take a 60-40 portfolio and think, how can I improve it for a period of fiscal dominance? Well, one, you can take out some of the bonds and replace that with some gold, for starters. And then you can take out some of the equities and replace it with Bitcoin. So I generally don't really view them in competition. I just generally view them as replacing different parts of the portfolio. I think gold is more of a competition for bonds, and Bitcoin's more of a competition for some of the higher volatility parts of a portfolio, such as equities. So I don't think it'll snap back. And to the extent that it snaps back a little bit, it's potentially higher employment. But basically, the biggest reason for that, number one, is demographics. So we started to enter an older demographic period. And because our economy has a pretty extensive entitlement system, that means more people drawing from Social Security and Medicare than paying into it. And so that increases our deficits, even at a time when we have low unemployment. And in addition, we ended a 40-year structural period of declining interest rates. And so for many years, we had rising debt to GDP, but that was offset by falling interest rates. So it kind of kept interest expense manageable. But now when we enter a period, even if interest rates are not structurally rising, if they're just kind of in a choppy range now. So if you're not falling from like Volcker era all the way to zero, if instead you're just kind of bouncing between 2 and 5 for the foreseeable future, let's say, you no longer have that offset, even as you're running pretty significant deficits. And so the combination of higher interest expense and more seniors drawing from the entitlement system, that puts just more structural strain on fiscal deficits. And to the extent that we do get a uptick in unemployment, generally speaking, you should expect that fiscal deficits to also probably widen to some degree. So it's pretty hard for those alligator calls to close anymore. And that's partially why that's fiscal dominance in a nutshell. That's basically, that is a different investing environment than people are used to for the past 40 years. So I don't have an opinion on who. I have an opinion that it'll be more of a dovish, more of a accommodative appointment based on the president and the current makeup of Congress. And my general expectation is that, by 2026, we'll probably have lower average interest rates. It's important to note that the Fed chair is not a unilateral decision maker. It's a committee. But overall, I think basically we'll be in a generally more dovish position. Long end rates, like I said, maybe sideways. That's more of a trading question of what's going to happen in any sort of 3 to 6 month period. But it's important to keep in mind, and generally in recent kind of discourse, I see this often mixed up, that just because the Fed cuts rates doesn't necessarily mean that, say, mortgage rates go down or long end treasury rates go down. And so you could see them cut rates and the yield curve steepens just by them staying roughly where they are. And so my general base case is mildly lower short-term interest rates over the next year or two, flat and choppy longer in rates, depending on what happens with tariffs and what happens with any sort of unexpected shocks along the way. One of the, I think the key things worth pointing out is that we're probably not going to get a really big housing refinance cycle this time. So generally speaking, when you do get a rate cutting cycle, especially when longer in rates do go down due to some degree of kind of economic slowdown, one of the silver linings is that homeowners can refinance their mortgages and basically get a free lunch. And the problem is that I don't think we're going to get a lower low in mortgage rates, which will generally limit how much refinancing volumes happen. And it'll mostly be limited to people that unfortunately kind of locked in higher mortgage rates, kind of in 2022 and beyond. And those people can get potentially a little bit of a, ability to refinance, but that'll be a much smaller burst than we're used to. And therefore, especially combined with tariffs, I think it'll put some pressure on the consumer. So I generally think that we're in more of a malaise going forward. So it's not doom and gloom. Until I see signs that say otherwise, I think we're in a little bit of a pretty range-bound period in terms of economic performance. And then my guess would be also top-line equity performance, but we'll see.